Hey crew, what's going on? Hayden Crabtree here, back with another great video. Today, we're gonna be talking to anyone and everyone who eventually wants to invest in commercial real estate, how commercial real estate loans work, and why this is a super important video for you to understand of how commercial real estate loans differ from residential loans, which a lot of people may or may not have gone through that process. There are a lot more people in this world with a residential loan than there are people with commercial loans. So I wanna make this video kind of as a way to show you, if you are going and getting in the commercial real estate world, what you can expect out of going through the loan process and how hopefully I can help you make that a lot smoother of a process. So with that being said, let's dive in, and I want to get rocking and rolling so you can be a better real estate investor. So the first thing to understand about commercial real estate loans and how they differ from residential loans is how banks actually view the approval process. So in commercial real estate, we have what we call asset-based lending. Okay, and what asset-based lending is that the bank cares a whole lot more about the asset, which in this case, the asset is the property that we want to buy. The bank cares a whole lot more about the asset than they do the borrower. Now, that doesn't mean that the borrower is not important in the equation, but on the flip side, whenever we look at residential loans, what we know for sure is that the bank cares way more about the borrower than they do the asset itself. And the reason that we know this is because whenever we go through and we get commercial real estate loans, the bank asks us for all kinds of documentation. Now, in both situations, they are pretty much required to have third-party verification of the asset value. So if we're buying a property for $1 million, the bank is going to give us a percentage of that. Let's call it 70%. They're going to loan us $700,000. Normally what the bank will tell you is that they will tell you, we'll give you 70% of the purchase price or the appraised amount, whichever is lower. So if you've got a contract on this for $1 million, but the appraisal comes back at $900,000, then the bank isn't going to lend you 70% of $1 million. They're going to lend you 70% of $900,000, which is going to reduce your loan that they're going to give you from the $700,000 down to $630,000. And you're going to be forced, if you do want to buy this property still, you're going to be forced to come up with that extra money out of pocket on your own, not in the form of a loan. So they have to get third-party verification in that way. But when you're applying for a loan for a commercial piece of real estate, the bank wants way more documentation about, hey, send me all the rent rolls, send me all the P&Ls, which is profit and losses, send me all of the leases on the property, send me your underwriting, send me your projections, send me your pro forma. Let's talk about what kind of debt service coverage ratio this property is going to have. So they're going to ask so many more things about the property itself versus whenever we're going and getting a residential loan, all the lender says is, okay, that's great. What's the address of the property? Cool. Send me your employment information. Send me your tax returns. Send me your income information, right? So the difference here is that in the asset-based lending model is that they want to know, can this property support the debt service on its own? And the debt service coverage ratio or debt coverage ratio, it could be DSCR. Debt service is just a fancy word for mortgage payments. And so the DSCR, they're going to want that to be higher than 1. What that number is that number is the NOI divided by the debt payments, and that's expressed in an annual term. So it's always great for our DSCR number to be above 1. If the DSCR number is at 1, what that means is that we're going to have $100 of income from the property, and we're going to have $100 of mortgage payments. So 100 divided by 100 is going to give us 1. And what that tells us is that there will be no cash flow from this property because every single dollar that is profit of this property is going towards paying our debt payments. So banks don't like that. 1 is like really scary, to be honest with you. You never want to see debt coverage ratios be at 1. You really want debt coverage ratios to be at 1.15 or higher. The higher we can go, the better, okay? But generally banks, 1.15 is the minimum that they will accept. And I've even seen since COVID, those numbers get raised up to 1.25 all the way up to 1.4 at certain banks. Okay, so what this can tell us is because of the rates, because of the terms, meaning how far out that payment goes, the interest rate that we have to pay, all of these can vary the DSCR. So we could borrow let's go back to our example. We could borrow $700,000 from somebody, but depending on the terms, the interest rate, the amortization schedule of that, just because we borrow $700,000, that does not tell us what our DSCR will be. What we have to figure out is what kind of loan terms can we get that will support a healthy DSCR number. So again, the DSCR number is NOI divided by mortgage payments, and that's expressed in a year. So banks, whenever they're looking at asset-based lending, is that if I'm a super strong borrower, if I'm worth $10 million and I have all the money in the world, but I want to go out and I want to buy a property that doesn't have a healthy DSCR number, then the bank is probably going to tell me no, right? Versus if I go out and I buy a home, just to kind of rewind there, even if that property appraises for the right amount, but the DSCR numbers aren't there and will never get there. If we're buying a property that's, it has 10 units and only 5 of them are full because the current owner isn't paying attention, and I can show the bank, hey, we're at a 0.8 DSCR coverage right now, which is really bad, but I have a game plan to get me to 1.25, 1.5 DSCR, then the bank is going to say yes. But if I just say, hey, this DSCR is at 0.8 and that's the best it's ever going to get, they're going to tell me, no, I'm not going to approve your loan. Doesn't matter how strong you are. Versus on the flip side, if we go out and we want to buy a home, and let's say the home maybe at the top of the market, and I'm going to pay $2 million for this home. For a year ago, it was worth $1 million. As long as my personal income can support those mortgage payments, and as long as the appraiser checks off and tells the bank that it's worth that amount, the bank will give me that loan. It doesn't matter about DSCR because they're not viewing those residential loans as an investment, as something that's going to produce income. Mainly because when you're buying a personal house, they don't produce income. And I've also seen this a lot too whenever you're doing residential investing. Some lenders will not accept the rental income from the property that you're buying towards helping you achieve the financial status of getting that. So what an example may be is that if you've got a W-2 job, if you have a job and you're going to go buy a rental property, they want for your personal income that you have in place to be able to fully support those new mortgage payments. And sometimes the lenders will not accept the rental income. So let's say the mortgage payment on this house you're going to go buy is $600 and the income from that property is $1,200 a month. They may not accept that $1,200 a month income in your financial situation towards going and buying that home because it's a residential loan and it is a borrower-based lending situation, not an asset-based situation. So when you're in commercial, it's all about projecting and forecasting and showing the lenders how much income the property is going to produce and how that's going to relay over into what kind of DSCR they're going to get on their loan. So the other things that we need to talk about are interest rates and amortization schedules and balloon periods. So number one, interest rates. Because investment properties, commercial properties are almost always going to be an investment. Sometimes they're owner occupant for your business, but they're never like residential, I'm going to live here. Because that's the case, there's a lot less government programs, there's a lot less government backing, and therefore the institutions, the banks, have to lend you the money themselves. And so what that means is that if the government is not going to subsidize that, then the bank is going to have to do it all on their own, and they're going to want a higher interest rate. A lot of times banks are willing to give you money at a lower rate than what they actually would because the government will subsidize them and they will tell them, hey, if this loan fails for any reason, we will reimburse you as a bank. So that's a risk-free loan for the bank. Versus in the commercial world, if it fails, the bank has to eat those losses, and therefore for their risk, they're going to charge you a higher interest rate because they want to make more profit. They want to get rewarded for taking more risk on you. And in this case, the risk is that the government is not protecting them from any sort of losses. So they're going to have a higher interest rate. So if you feel like, interest rates in the market in today's world, we're at 3% for residential and you get quoted 5% for commercial, don't feel like that's, just the world's highest interest rate, because commercial investment property loans in general are higher. The next thing is the amortization periods, which is how long you're going to pay that mortgage off. When you're going to get a home loan, you can choose a 15-year mortgage, you can choose a 30-year. Those are the amortization time periods. Well, in commercial, a lot of times those amortizations are shorter. They can be anywhere from 10 years to 20 years. I've seen 25 years and I've seen 30 years, but I would say the standard for commercial real estate that is non-apartments, all loans that are non-apartments, the standard is 20 years is normally what you're going to get, whether that's storage, whether it's industrial. A lot of 20 years are really, really popular. Okay, and why that is that banks want to get their money back sooner. And they just don't have the government subsidy to protecting those mortgages over a long period of time. And banks also, they want to be able to get their money back in case interest rates change. So one way that they protect themselves is through balloon periods. When we go out and we get a mortgage on a home, whether it's a 15-year or it's a 30-year, we almost never have to pay that off. As long as we hit our payments each and every single month, no matter how much those payments are, we will never have to pay that off unless we sell the property. Well, in commercial real estate, because again, the banks, they're taking a risk on you, they're using their own capital, the banks essentially need some sort of reset on the interest rates, because interest rates can change a lot very quickly. They can go up, they can go down. And so if you have a interest rate at, let's say, 5%, and interest rates in the market go up to 7%, you as an investor have that bank's money. So let's say it's the $700,000. You have that $700,000 and you're paying 3% on it. Versus if they could get that money back, they could lend it to somebody else in the market at that new higher interest rate. So every single day that goes by that you've got their money when interest rates in the market have gone up, that bank is losing money where they could be earning higher money. If they have that money back, they can lend it to somebody else at a higher rate. So the way that they protect themselves is they put in place balloons, and in commercial real estate, balloons are a lot shorter. I would say the standard balloon period in commercial real estate is 5 years. I've seen as low as 3 years where banks want to give you the money, let's call it on January 1st, and in 3 years they want all of that money back, whether they refinance that themselves, whether you refinance it with another bank, or whether you sell that property. In 3 years, that is not a long time in the commercial real estate world. Things can happen very, very quickly. Markets can go down. If your loan comes due, you're in a lot of trouble. So this is why I always want long-term debt. The minimum balloon period that I will get is 5 years. I will not take any less than 5 years, because that allows me to have time and plan for things. If my loan comes due, I have time to figure out what I'm going to do on that to make sure I don't get in trouble like so many people in 2008 did, where their property was doing fine, they didn't do anything wrong, but because they couldn't get new loans and their balloons were due, it was a really bad situation. So the balloon periods, that is another thing that can really hurt you in the commercial real estate world if you're not careful. One thing to know is that all of this is super negotiable. Okay, so what that means is that a bank could come to you and they say, we'll give you a 5% interest rate, and we'll give you a 3-year AM or a 3-year balloon and a 20-year AM. I always go back to lenders and I'll say, I'll take a 25-year AM at a 4% interest rate with a 10-year balloon. I'm negotiating with them. Just because they tell you terms doesn't mean that that's not negotiable. They want to give what's best for the bank, and you as the investor have to ask for what's best for you. Okay. So all of these different things contribute to how commercial real estate can be different than residential. So I hope that this was super helpful for you guys. If you have any questions about how loans work, how commercial real estate works, grab a copy of my best-selling book, Skip the Flip, Secrets the 1% Know About Real Estate Investing. The link is in the description, absolutely free. And if you learned anything, if you learned one nugget from this video, share this video, like this video, and subscribe to the channel. I would really appreciate it. If you have any questions about commercial real estate loans in general, drop me a comment below. I'll do my best to get back to you as soon as I can, because it's my goal to help 1,000 people become financially free by buying their first rental property, and that's my mission right now. So subscribe to the channel, check out some more of my videos. I'll see you guys on the next one. Have a great day.